Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, you've often heard us talk about investments. When to invest, where to invest, how to invest, and of course, what to invest in. But perhaps not enough time and thought is given to the question around exiting our investments. When and how should we exit the investments which have done their job for us in our portfolios? Well, that is exactly what we will focus on this week, setting up a framework for scientific and planned exit strategies. And this can also, of course, help us plan our retirement more effectively, among other things. Joining me to do that this week is Mrin Agarwal of Finsafe India. Mrin, thank you so much for joining in. Welcome to the show. And this is, I admit, this is a question that even I don't ask enough. So I thought it's an important conversation to have. Do you agree?
Absolutely, Surabhi.
So, I want to tell you about the genesis of this thought. I think when the market was, going through a correction, that is when a lot of people were wondering that, yes, of course, you keep buying in when the market is falling. But people also wonder that, OK, I've made a lot of profits since COVID. Should I be now booking some gains? So you tell us, what is the overarching principle when it comes to exiting investments and, taking that profit home?
All right. So, yes, we often talk only about investing, and very often I do see that people do not have an exit strategy in mind. So, three things that you have to keep in mind when do you exit a fund, right? First is, of course, if it is near to a goal. So, if you have done goal-based investing and you are nearing your goal, then, of course, you do need to look at exiting the fund. Second is if the fund is underperforming, right? Or if there is rebalancing required. So in a situation where, for example, one asset class has become, has had a higher allocation. Let's say if equities has gone up a lot and you're having more equity than what you really need to have, that's when these are the three reasons why you would need to basically exit your investments, right? So when we talk about each one of these three cases, right? When do you check for underperformance or when do you check for rebalancing? It has to be only once a year. And also, once when you check this performance, it's not like you see that the fund is underperforming for 1 year. So then you just look at exiting it. You will still need to track the performance of the fund for a period of time. And you have to do the right tracking, right? It's not like just saying this X fund gave this much, my fund gave this much, so I'm exiting. No, you need to look at what is the performance of your fund versus the category average versus the benchmark, and then track it for a period of time. And the same thing goes for the rebalancing as well, right? I mean, it's not something that you would do on a 3-month basis. You would need to look at it on a yearly basis. And the last thing is on the basic framework, especially when you are near a financial goal. And we saw this in COVID. We saw this earlier this year, a couple of months back when the markets were down, that when people wanted to withdraw their money for their goal, if the markets are down, obviously your investment value is also going to be down. So to protect yourself against some of these situations, especially if you're exiting before a goal, one of the things that you do need to do is that at least a year before the goal, look at what is the value of the investment. If it is somewhere near to the goal value, look at protecting whatever part of that investment by moving it out into a safer instrument, right? So this is basic framework.
Okay, that's a great starting point. Helpful thoughts there. But Mrin, I want to go back to the basics, really, financial planning 101. And I sometimes wonder, because obviously planners tell us to, plan for specific goals. Take a holiday in 3 years, buy a car in the next, 4 years, or look at retirement in the next, say, 20 years. But at the same time, when we look at our portfolios, usually people have a bouquet of mutual funds, mid-cap, large cap, small cap, thematic, etc. In your experience, how do we marry the two? Have a certain set of funds which are for specific goals, but then you have an overall bouquet, which could be mid, large, small, thematic, defense, etc., passive, active. So how do you set for goals within an MF portfolio?
So there are various ways of doing it. Some people would just like to do it on an overall basis to say, I have this portfolio and then I'll decide at the time of exit. I think the better way to always do it is to say, this is my goal. To this, I will tag these three or four investments or these three or four funds for this particular goal, because then it becomes easier for you to basically do the exit, right? Because then okay, if this is my goal and I need this money, these are the three funds I've tagged, and you just exit those particular funds. So I think it's basically what works for each individual, but I would seriously suggest tagging in specific funds for specific goals.
Yeah, absolutely, because that's what I was wondering. I mean, you might have a huge chunk of your money, let's say in large cap funds. Now, your goal might be a holiday, but you really want to exit, your entire position in that large cap fund for a holiday that could cost you, say, 2 lakh rupees. So, okay, so you're saying that, bucket it in individual goals and then list the specific funds to arrive at that goal. Got that point. Mrin, on the point of when you're nearing your goal, and you said you then need to start, exiting before you hit the date of the goal. So give us some examples of how this may work. Maybe medium-term goals, short-term goals, even long-term goals. So say the plan is to buy a car over the next 2 to 3 years. How would you plan for it, and when will you start the exit process?
See, as far as short-term goals are concerned, like 2 to 3 year goals, in any case, you would only look at debt funds in such cases. So there it becomes fairly simple. You can pretty much withdraw at the time of the goal itself, where the short-term goals are concerned. But when you actually have longer-term goals that you've planned for, let's say child's education and you need to pay college fees, right? So what I did this for myself as well, wherein a year before the college fees had to be paid, and whatever that amount was for the 4 years, right? So that was in any case what the goal value was. So what I did is that, whatever, like it was pretty close to the goal value. So I actually removed the entire money and I went and put it in a debt fund. Now that may not be the situation for everybody. You may be still far away from your goal value, right? So in which case, I think one of the things to do is that maybe start withdrawing money over tranches. But certainly, if you have invested in equities for a goal, I would not look at withdrawing at the time of the goal, because you don't know what the market is going to be like, right?
Yeah.
So I would just play cautious in this case rather than saying, no, I want to maximize my returns or I want to wait and increase my corpus, right?
Okay. Yeah, fair enough, because you don't know. I mean, when you're about to hit the goal, suddenly there might be a 10-15% drawdown as well. May not be in your favor. Got that point. So, this whole conversation on rebalancing, let's take COVID as an example, Mrin, because a lot of people who entered the market at that time managed to buy the dips. They've seen sizable appreciation in their wealth, right? And now they're looking at a market which is range bound, and sometimes you've had volatility on the downside. So now let's apply the exit framework here. Should they exit? Should they not exit? What would be the route? What should someone be doing if they're sitting on 5 years of gains since COVID in their mutual funds?
See, I would always say that, it's like where mutual funds are concerned, it's not handled like stocks, right? And the point is that, let's say you've had some great gains, but you'll still have a reinvestment risk, which is like, where do you go and invest the money, and at what rate is it going to grow, right? And this is what I always tell investors, like when people say that I invested in this fund, but it's not doing well, and there's some other fund doing well, or this whole conversation that was happening around gold as well, right? To say that gold is better than equities, so should I move my money to gold? And my question is, how do you know that this performance is going to sustain, and how do you know that gold is going to do better than equity, right? So when you look at data, and I found this really nice data actually available, wherein they have looked at various tenure periods, and they looked at buy versus hold versus doing profit booking at 20%,
And then
30%.
reinvesting, yeah.
Yeah, and reinvesting. And actually, if you pick up any data, it's going to show you that buy and hold always works in the long term. So I am a great believer of goal-based investing. And I would say if your fund has done very good, well, that's great. Continue to hold it. I mean, why are you penalizing the fund by exiting it, right? So I would just say stick on to your investment. If it's done really well, continue to stick on with it till the period of your goal.
That's really reassuring to know that, this propensity to book profit and then to reinvest, find that dip again in the market, that is not necessarily the path to long-term wealth and prosperity. Buy and hold. And that's the easier thing to do as well, right, Prince? So I think that would work well for retail investors. Brings me now to the next question of rebalancing. So if you could just elaborate over here, what all entails in rebalancing? When you sit with your planners or your advisors, what are the questions that I should ask? And when do I need to rebalance my portfolio?
So once a year is enough. You don't need to do it more than that. And you can decide if you want to do it on a calendar year basis or if you want to do it on a financial year basis, whatever works for you. Now, the first thing that you need to consider is what is the asset allocation and what is the deviation from the asset allocation, right? So you need to set an internal benchmark as to at what number or at what deviation percentage are you going to do that rebalancing on an annual basis. Now, I think that number of 15%, 20% is a good number. So what it means is that, let's say that you have 60% in equities and you have 40% in debt, and that 60% becomes 75%. So there's a 17%, 15% deviation basically. So you might decide that at a 15% deviation on an annual basis is when I'll start doing the rebalancing, which means I will get my equity back down to 60%. So that number of that deviation has to be decided by the investor. As I said, it could be 15, 20%, right? Now, what funds do you exit then? What funds do you rebalance? So let's say you have a set of equity funds and you have to bring down your equity allocation. So the easiest one would be to look at the funds that are underperforming or where you have very, very small holdings. And this is very common, because people just tend to buy these NFOs, or I would say, unfavorable funds. Like, for example, if you have thematic funds or sector funds that you might have just got into, or if there are small holdings, or if you're having a lot of duplicate funds. So, now in this era of ETF investing, very often you see people having four Nifty 50 ETFs, right? Which is actually duplication. So, these are the factors that you look at first, either underperforming funds, small holdings, duplicate funds, or funds which shouldn't be in your portfolio, let's say like thematic or sector funds. Now, if you don't see any underperforming funds, for example, you've had a good year and you've bought all the right funds and nothing is underperforming, then you basically have to go and see that which category do I want to reduce? Do I want to reduce large, mid, or small cap? So basically, essentially based on your risk profile, what risk profile you want to maintain or what risk profile you want to be in, you keep those funds, and the ones that you reduce, you reduce those. So this is about reducing. But when we come to increasing, because there's also increasing exposure in a fund, right? It could be the other way around, where equities have had a bad year and you want to increase exposure. So of course, over there, you want to ensure that you're well diversified and that you're not over allocated in one fund.
Absolutely, absolutely. Well said. But Mrin, the tough part is to reduce allocation to a fund or to an asset class that's working very well. It could be mid caps one year. It could be gold this year. And we're getting questions on this as well. If you could just take up the gold issue, a lot of portfolios, because we historically have gold holdings, there people might have gold coins and bars, and there's obviously the jewelry exposure. Then a lot of people have invested in sovereign gold bonds or gold funds and ETFs. But it's hard to reduce exposure when that asset class is still doing well. So specifically, when it comes to rebalancing, what would you advise on gold now, looking at the market?
See, if you're very, very overexposed and you're finding it difficult to reduce, let's face it, as a financial advisor, it's easy for me to come and say that come and reduce your exposure, right? But if you're finding it difficult to do it, I would just say, okay, stick on to it, but don't add more, certainly, because the bigger issue that people have is that when mid caps are doing well or when gold is doing well, they will go and add on more. So at least if you're not reducing it, don't add on more, certainly. And end of the day, somewhere you'll have to keep in mind the allocation, because see, when the markets are going up or when everything is looking very good, it's all good, right? But then when you have that fall is when you're going to have a big fall. So somewhere I would say that you'll have to think about these factors for sure.
Absolutely, absolutely. Got that point. We need to take a very quick break. But when we come back, we apply this whole exit framework to a long-term goal like retirement planning. How do you ensure that you start coming out of funds? Which are the funds to start exiting as you're approaching a landmark moment like retirement? Back with that in just a bit.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we're discussing exit strategies, how to exit your funds smartly so that you maximize the output. Now, Mrin, specifically, I want to talk to you about systematic withdrawal plans. How important are they when we are talking about exiting funds where we may not need the entire lump sum money upfront?
Yeah, so very interesting. I've seen that SWP or systematic withdrawal plan is something that's gained a lot of traction in the last 1 year. And I'm often asked about it as a route to creating wealth, right? So I would like to clarify a couple of things. SWP is a product where you basically want to take out money on a regular basis. So it is the opposite of the SIP where you're investing. Here, what you're doing is that you're trying to set up a regular cash flow. So it's a product for regular cash flows. Now, couple of things that you have to keep in mind in the SWP, right, is that, see, whenever you want regular cash flows, it has to be from a product which is growing at a stable rate and which has surety of returns, right? Now, I'm seeing a lot of people talking about setting up SWP from equity funds, which is a little concerning for the reason that equity funds can be extremely volatile. So, for example, let us say that you have some amount, let's say 1 crore, and you think of setting up an SWP, but then the markets fall by 10-15%, as we saw earlier this year. So everything is going to go out of whack, right? I mean, all your calculations and everything are not going to hold good, whatever you've done, right? Like if you started with 1 crore and you're removing some amount every month and the markets fall, your 1 crore is going to come down, let's say, to 85-90 lakhs. Obviously, all the calculations that you've done are going to change, right? So very, very important that, you need to get the reason for doing your SWP correct. That first, the SWP is meant to generate regular cash flows. It has to be done from an instrument which gives stable returns like debt funds and certainly not equity funds. And point number 3, the SWP also needs to be planned well. And I'll explain this through 2 examples, right?
Mrin, I get your point. What you're saying is that don't do SWPs directly from equity funds because equity funds can be volatile. Let's take an example. Let's say that, someone is looking at regular income after retirement. Let's say they've got a corpus. They've got either a 1 crore or 2 crore corpus. How should they plan the exit via the SWP route then?
Yeah, so 2-3 things. See, now if you make an investment, let's say into a debt fund, and you start the SWP right away, it's like you just getting your money back over a period of time, right? So I think first thing is that you should actually invest in a debt fund for, let's say, at least a 3-year period, and then start the SWP because then you've built some amount of gains over the last 3 years, basically. So that's the first thing to be kept in mind. Second is you have, I think, some SWP calculators that are available online, but actually I would actually suggest that please plan this with a financial advisor because it's not that easy. I'll give you an example. Let's say that you start with a 2 crores corpus and you want to withdraw 1.5 lakhs per month. And I'm assuming return on investment at 5%. I'm looking at a post-tax return on like a short duration debt fund. Okay. So you've got a 2 crores corpus. You've put that money in a short duration debt fund and you want to withdraw 1.5 lakh rupees every month. If you do the cash flow calculation, this money is going to get over in 16 years, right? Let us say you wanted to plan for the next 20 to 25 years. You're actually going to fall short because the money is only going to last 16 years. So there is another plan that you can do with the SWP, which is that you invest part of the money. So in the same example, you invest 1 crore and in the short duration debt fund and you start the SWP. Same way, 1.5 lakhs every month, it's going to last you for 7.5 years, right? Now, the balance 1 crore, you can invest into a balance fund for about 5 years, move that money into a short duration debt fund, and then start the SWP. So, what happens with that is that then you are able to have the SWP running for about 19 to 20 years. And that way, you're able to meet your requirement of getting that amount on a monthly basis. Because what you've done is that the first part of it, you've invested, you've ensured that you're getting your cash flow for 7 years. The balance amount you invested into another instrument to grow the corpus and then start the SWP on that, right?
Oh, so this is interesting. Basically, you're breaking this up. You're letting one part of that corpus continue to compound in an equity instrument, and you're remaining, the other half of that corpus is being put in a debt instrument, which is more stable, and then you do a systematic withdrawal plan from the debt portion of it. Got that? That makes a lot of sense. Mrin, we are trying to just squeeze in some viewer queries here as well. If you can, quickly answer these. Because viewers have been writing in saying they have some doubts on mutual funds. So I want to take this query that's coming up on coming from Sam on Instagram. He's saying, what is the difference between value, growth and momentum funds? And how should I look at their composition in my portfolio? Do I need to rebalance? Do I need to add them? What should I do? Mrin, new fund categories, many of them on the passive side.
Yeah. So the value funds are funds which invest in stocks, which are basically trading, below their true value, basically, and they're expected to essentially grow in the long term, but they're undervalued at this point in time. Growth stocks are, of course, from sectors that are expected to grow well over a period of time and give you sustainable growth. And momentum investing is all about investing in what is basically trending, right? So in a very, very simple way. Now, what should be the allocation of each of these categories in your portfolio is totally dependent upon the risk that you want to take. Certainly, momentum followed by growth, followed by value. That is your high risk to lower risk. So if you want to take a very high risk, if you're able to take high risk, then you could have a higher amount in momentum. If you don't want to take high risk, if you want to be more conservative, you could do value funds. It's all dependent upon what is the sort of risk that you want to have in the portfolio, basically.
Okay, absolutely. So that, I guess, is the golden rule for rebalancing. First, assess your own risk profile, your own requirements and your goals, and then look at your portfolio. So final thoughts, Mrin. I mean, this is a very helpful conversation. So just recap this for us in a nutshell. Exit strategies and the question of exit via an SWP versus lump sum exits. Just what should be a holistic framework to follow?
Okay, so first and foremost, look at exiting only if you're close to a goal or if you're looking at doing rebalancing. That's point number one. Secondly, lump sum versus SWP. So lump sum, of course, you can withdraw and then you can design like whatever sort of strategy you want for your withdrawals. But there does exist a systematic withdrawal plan, which is actually a very good feature that's there in mutual funds to get regular cash flows. But point number one, always, I would say, of course, do it in a debt fund because equities are really, really volatile. And secondly, plan it well. Use the SWP calculators online to figure out as to how long the money would last based upon what is sort of withdrawals that you're doing. And as I said, if it's really not tying in with your time frame, then see how you can work with a financial planner or get someone to basically design it out for you.
Okay, all right, Mrin. Thank you very much for joining in. Sometimes, something that sounds so logical and commonsensical escapes our mind. So it's important to discuss it and put it out there for everyone's reference. Thanks very much for joining in and sharing your thoughts with us. Well, folks, that's a wrap on this edition of Let's Talk Money. Hope you found this conversation useful, simple and systematic, not just when it comes to your investments, but when it comes to your exits as well. Keep sending us your feedback, comments and queries. We'll see you with another conversation next week.
Let's Talk Money